Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. That's not morning. Afternoon. It's an afternoon for everybody except for you guys in LA. None of you watch my stream anyways. Dude, we have Federal Reserve meeting coming here. And this is going to be nuts, oh man. This is just going to be nuts. Even if we get like a really clear indication, like you're informed and you can make money, you've got to have wide stops on this, man. This is just going to be nuts. And I think that for most retail traders, probably you don't want to trade this, but let's see what happens. We are here in the treasuries. We're about 16 ticks, or sorry, we're half a handle. We're half a handle higher. So when we left, you know, things were kind of coming back up to where they were, and it was just kind of like, this is kind of iffy. But since then, it's just kind of been clear trend buying up to the tune of about 20,000 contracts. So there was something out there. Was it somebody betting on an easy Fed? I don't know. But this is going to be bonkers. Absolutely bonkers. So let's just relax. Today we are going to try and pay attention to what the Fed chairman is saying. I've taken my medication. I'm ready to pay attention and see what happens, because anytime that we come in, we're like, oh, this is like the big Federal Reserve meeting. This is a big one.
At 3 p.m. Eastern time, we get
this one's good, big.
Forecast of a 25.
They're calling this the Volcker moment, which is like, even though the banking sector is falling apart in front of our eyes, we're still going to raise interest rates 25 basis points. Seems like what people are saying.
As of 8 a.m. this morning.
Seems what the market is saying.
86.
Need to close down the squawk. You shouldn't be able to hear that yet. Can they be pivoting already? We'll see what they say. I mean, the thing is that we have not heard really a peep out of Powell or anybody from the FOMC for the last 2 weeks because of the blackout period. And in the past, we've seen the Wall Street Journal come out and kind of tell us what's going to happen or what they're thinking or what. I don't get. So I really have no clue what he's going to say or what this is going to be. The minimum that could happen is no change. Just realize, even if it's no change, there's still going to be significant amounts of movement. I'm sure Powell was up all night. We'll see. The news squawk is just mentioning something key is that, the ECB increased last week. So that's probably a pretty, that's one reason why the Fed would be very likely to continue raising as well. I started the stream a little bit earlier than we usually do, so I just kind of need to relax here. Last night, I was working on a track and I had a little break, so I went in and I made like one little change to it. Made the one little change to it and then went and took it out in my car and it was bumping. Oh, I loved it so much. I'm so hype about it. It's just about like the most hype thing I could make. So like, I don't know. I just got the song stuck in my head. I'm thinking about the song and not the Federal Reserve meeting. I'm sure that will change when this actually moves, when we hear. But this is going to be. Extending deposit insurance won't save banks. It solves the wrong problem. That I'd be interested to read. Isn't there a thing? Well, I think that music is a really effective way to like generate that dopamine and stuff. So, like, it drains your attention even more. Music is a really good, solid source of dopamine. I think it would be the case that, like, if you are studying, you probably don't want to listen to music. I don't. Like, when I was studying for the Series 65 exam and I was taking the tests, I would just play white noise in my headphones to drown out any noise outside, but... So I'm reading this story and they're saying that the deposit outflows from these banks that fell were accelerating in the weeks before the failures. So why was there a big deposit flight out of the banks before the failures? As rates went from 0% to 4% between March and November 2022, inflows into money market mutual funds were a paltry $62 billion. This changed when rates crossed above 4%. $143 billion flowed into money. So he's saying that once we crossed 4%, all of the money came out of the banks and went somewhere else. This is Jim Bianco. So if the Fed hikes tomorrow, they widen the spread even further and the yield seekers will have even more incentive to leave. The banks will bleed and bleed and bleed deposits. Why should the yield seekers stop moving their money? They already downloaded the app. They reset their password, they figured out how to move money, and they are not going to unlearn it. The only thing that stops the constant bleed is to close the savings rate to the market rate gap. With the Fed hiking tomorrow, the only way to close this is for bank to hike deposit rates. Yep, but that kills profitability. Why does it matter if a regional bank bleeds deposits? medium banks account for 50% of C&I lending, 45% of consumer lending, 80% of commercial real estate lending. If regional banks keep bleeding deposits, even it is slow enough that they don't fail, it will lead to a credit contraction for these sectors that will hurt. This is a liquidity crisis, not a solvency crisis. But the scars are so deep from 2008 that we must change this to a solvency crisis by the lack of duration hedging. This is not the problem. The problem is the record bleed out of deposits and mobile banking, making the velocity of deposits much higher than any previously imagined. The risk is a credit contraction. The solution is to close the savings rate / market rate spread to remove the incentive to leave. So if the Fed raises, I think that if the Fed raises rates, they probably sell. But since that's the expectation, that one's a little bit more clear. If the Federal Reserve were to like really surprise the market and do a cut, then the treasuries would absolutely buy. It would be nutso. It would be nutso crazy, right? Oh, I was just reading a story from what's his name, Jim Bianco, about why these banks are having problems. Okay, so 1 minute. And you can see the liquidity has completely pulled in the 10-year treasury. And I mean, it has completely pulled. News Squawk posted a picture of Katniss Everdeen doing the little kiss thing for the Federal Reserve coming up. That was their approach to it. Oh, do you feel the electricity coming in now? I can just taste it in the air. This is gonna be some nut stuff. Right, here we go. 3, 2, 1. Hike. So as expected, they're buying on that initial thing. Well, let's see what the statement says. Okay. So it sounds to me like they're actually pricing in some rate cuts next year, and that's why they're buying here. Okay, so here is the image. I'll pull it up here in a second. Nick Timmerose, the Fed raised 25 basis points. The decision was unanimous. The terminal rate projection is unchanged. FOMC statement modifies their guidance. The committee anticipates that some additional policy firming may be appropriate. Recent indicators. Okay, so they changed that inflation has eased but remains elevated to just inflation remains elevated. And then they added the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects are uncertain. The committee remains highly attentive to inflation risks. They also added in here a little further down, the committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate. I do not see anything in that remotely dovish. They did delete the reference to ongoing increases in rates. So they, instead of saying the committee anticipates some anticipates that ongoing increases in the target rate will be appropriate in order to maintain the stance of monetary policy. They change it to the committee anticipates that some additional policy firming may be appropriate. So I don't know if that's as significant of a thing as, you know, the market might make it into. Terminal rate view is unchanged. Man, I tell you what, they moved. They moved off of that. From 16 to 040. Wowzer. That's a monster move, man. And a monster on the upside, too. Did the twos hit 4%? Oh, yeah, they did. They're still kind of sitting there. Oh, man. Let's turn the music up just to 10. So if I was just reading the statement and the actual change, on that alone, I would probably be selling. But since that was the consensus expectation, was a 25 basis point increase, and one of the changes that they were looking for was kind of like the thing that people were looking for. I think I could understand the buying, and there is volume behind it. So about 8,000 contracts net. Man, I tell you what, the spreads just like, ooh, they really steepened hard. They really steepened hard. I do think it's the dot plot that might be the biggest determining factor here. So the terminal is still at 5.1 is unchanged, and then 4.3 versus a 4.1% last, and then 3.1 versus last of 3.1. So I don't know if this is actually a buy. I could probably try the little scalps in here. S&P is buying. What? The amount of buying that I'm seeing in the S&P 500 is a little zany. I have the balls to short this. I do one soon. Oh, darn. Okay. Okay. That wasn't too bad on the spot. Hopefully they don't just bidoosh. Keep climbing up here though. I'm not gonna fill the 23. So that's awfully tight given the conditions, isn't it? That makes you gotta wonder. Not quite so well. Okay, there we go. Fill. A little bit of fight there now at 23 and a little bit of a slip lower. Did they just, I don't know, man. I have to say the flows that we got immediately following the news don't 100% make sense to me. I felt that the comments that they made were mostly hawkish. I don't see how this justifies a 50-point rally in the S&P 500, but what do I know? So if we come back to like right here, I got to take at least one contract off, because that would be back to the scene of the crime. But that doesn't even make sense to you. So here's the thing that's been bothering me lately about, and I was kind of hinting at this when I was earlier today when I was making a reply to one of L. Arian's posts, is that I really don't see the point in the statement, like that it's a 25 basis point hike and all that's all relevant, but like the whole statement, like, okay, the financial world just completely changed, guys. The financial world completely changed in the last 2 weeks. They like added one sentence into the statement. Like, what is even the freaking point of the statement at this point? I don't get it. It's like not indicative. It never seems to be indicative of where we end up going in the long run or anything. I think they need to make their comments about the statement more, and then there's like that whole thing that like he says at the beginning of his press conference that's like prepared remarks. Why don't we get that? So whatever. But the point was just to say that, okay, the initial reaction was up. Doesn't mean it's going to keep going that way. And these sorts of things have a way of making really big swings up and back down and up and doing all sorts of wild stuff. So, okay, federal funds traders see a 62% chance of a 25 basis point hike in May, says FedWatch. The Powell Fed attempts a dovish hike, reports Nick Timmeros of the Wall Street Journal. Oh, I got to fill. And there's a little bit of an ad there too. This is just gonna like jump right out here and like destroy me, isn't it? There's some real buy volume behind this side of it in the 10-year, not in the 5, but in the 10-year. Some serious buying there. That 1700 there at 25. Let's destroy this axe with our fund. Let's do it. Let's start a fund. You guys can do the money raising. I don't know if I'm the money raising kind of guy. Was it a terrible short on Z on what this morning? Well, it did end up going positive, but I don't know if we had any kind of information that said that it was going to go up. Fractals and it sounds like things I don't care about. I don't know how else to say it. Okay, come on. Bill me. Bill. Oh, come on. You can do more than 8. Yeah, there we go. It's like you can do more than 18 contracts. Come on. Funds of funds is always yeah. I think it would be really, really hard to run a fund of funds, man. It really, so I think that somebody must have known something, right? This morning. I think that somebody was coming in and decided to buy it up, and they bought it up almost all morning. And while we were trading, in the 2 hours that we were trading, it wasn't really very apparent. But now you're here like 4 hours later or whatever, 3 hours later, and the very clear trend emerged. The ES, almost completely reversed, yeah. I'm not completely in the clear with my trade over here. What I'm seeing at the moment is just a consolidating range, so well, I tell you what, you're getting good volume on both sides of the market here in the treasuries. I mean, it has been mostly buy, yes, but it's, the bids are getting hit too. Wonder if the whole pullback is gamma hedging stuff. Yeah. Oh, I mean, more so than that, you're always going to see a pretty crazy liquidity hole after an event like that, so it always kind of gets sucked back afterwards, right? But that's kind of why the default thing is like it moves up and then goes zigzag and then kind of flattens out, right? In a situation like this, though, you might get something else. You might get something like the people that were looking to take a trade immediately off of the statement decided that the statement was dovish. I don't know if that's actually what they thought, but the people bought. So maybe at the peak of that, somebody else comes in and is like, this is nonsense, and uses that as an opportune moment to go short and push it back the other way, right? You're sharing too much info? Yeah, probably. I mean, but quite frankly, I'm not interested in following somebody else's signal for something that they can't even explain. If you can't tell me what it is, and just don't even tell me that there's a signal or that you're using anything or that you want to buy, or because I just can't do that, right? The only way that I'm going to incorporate anything into my trading is if there's empirical evidence that suggests that there's a real edge to the thing. That's it. And when I hear you guys that try and make this thing that like you know what was going to happen, or you think that this price level is important or this price level is important, it just makes me think you're crazy. Oh, 25 half. I know that live action is not crazy, but Oof. So they traded through 25 in only 3 contracts. Well, there could have been a piece of information out there that strongly suggested that the reaction to the Federal Reserve would be what it was today and that you should buy. And that's probably my best guess as to why we had the movement this morning that we did. You went long Bitcoin. Well, I tell you what, the dollar got creamed there, right? So Bitcoin is up. Or it should be up, right? It's kind of mostly unchanged. But the dollar did get creamed. They lost 50 cents. That's a huge move for the dollar. Well, I don't like the way this is going over here. They've kind of been struggling in this 2026-ish area. But the sellers are having a very difficult time making any kind of headway. It kind of looks tilted to the long side to me. Yeah, I'm really concerned about Bitcoin. Like, this reminds me so much of the sort of stuff that we were kind of starting to see early 2021, early 2017, where it's like it really shouldn't go up. And I'd say that like it's in more precarious of a position than it's ever been. But unless a regulator steps in and does something, it probably will continue moving up. Because from what I can piece together from looking at the blockchain, the Tether is just going to keep printing more money. The announcement was 25 basis point hike, as expected. And the market put a decent rally on, but it is fading. New exchange, you know. I don't want anything to do with the cryptocurrency world anymore, guys. Like, for real. As long as Tether exists, and as long as Bitcoin Core are the ones in charge, I just want nothing to do with it. The whole thing is just turned into one giant hustle scam, whatever you want to call. There's no fundamental value to it. It's just speculation and money printing. Are the Feds expected to be more neutral / less intensive on rate hikes going forward due to recent events? Yeah, so that's the thing, is based on the way that the markets have moved, you would think yes. But that's not the reading that I got from the result. They only changed like 2 sentences. Stumbling through it extremely difficult since I don't have a programming depth. Well, okay, so then why would you want to start an exchange? The only garlic, yeah, only the garlic coin matters, folks. We need to get garlic coin listed on Coinbase. Then we can be rich. It'll be my first $1 million trade. It's when garlic coin goes live on Coinbase. Dude, if garlic coin was listed on Coinbase, that would be literally the most insane thing ever. Like that coin would like 10,000x. It would be nuts. There's no way it's gonna happen, but I can dream, right? Okay, so I could do it again. It's starting to get really tight though. I want to offer a competitive debt card purchasing fees on my platform. Oh boy. That sounds dangerous. That sounds like you want to try and be a bank without actually being a bank. Is what that sounds like. Yeah, most exchanges are 4%. So what, you're gonna offer 5%? How are you gonna make money? Like I said, I don't want anything to do with the cryptocurrency space anymore, guys. Oh, you want to offer 3 or 2? Oh, okay. I just think the regulators, I'm telling you, man, the thing that I think is that a regulator could come in and destroy Tether. Say this isn't back, this is all a scam, this is like really come in and like raid the place, sort of a thing, like with what happened with FTX, and the Bitcoin ecosystem would just be decimated. And I mean, it would be utter scorched earth. There would be nothing left, right? Like if Tether went under, that's just all of Bitcoin. Like, especially if they like came in and like halted it or something. Really would be like, it would be bad. So it's like your risk is you double your money, or your reward is you double your money. Your risk is you lose everything. Like that's what Bitcoin has become. I mean, that's kind of what it always was, but I feel like it's particularly dire. Like before it was like, well, if you're fast and as it's going on, and if you can move your stuff to the exchange, maybe you get lucky and you only lose 50% or something like that. But no, this one, it literally will be like you're going to lose everything, right? If crypto goes the way that I think. How well do you know AWS? I am only a little bit familiar with AWS, but I am a lot bit familiar with cloud in general, and I don't find too significant of a difference between the different services, especially if you're using Terraform to set things up. So if you use a Terraform script to create your infrastructure, it's kind of platform agnostic. I was thinking about doing a virtual machine for Google or something like that, but I ended up not doing it. I ended up just running the script on my PC all the time. And I think that I'll build like a server. You know, I have this server rack. I think that if I can find a case. Oh, it was the other day I found one on eBay that was like only $35, but they wanted like $90 shipping. Now, if the shipping is more than the item, that immediately makes me suspicious, right? So I didn't do it, but I'm kind of on the lookout. I can find a rack mount server and build an old machine with it and run my own Kubernetes node or something like that. What I think I want to do. I still collect the data. I still get all of that individual tick data. Just been saving it away, and I got a huge hard drive so I can save all the stuff. So Okay, so again, they're kind of hanging out on this higher side of things. Yeah, so the statement says the Fed will continue to reduce their holdings, yet the balance sheet is exploding higher. Well, but that's a different side of the balance sheet. Yeah, but the thing that doesn't make sense to me is you're gonna put all of this money out there, but then keep the interest rate high. Like, what's the point of that? All you're doing for that is just making it hard for everybody to do business. But I don't know if that actually like eases anything. Like, or rather, they could have just reduced interest rates. It would have had the same effect. I'm not convinced that quantitative easing is really all that useful or effective when you're not already at zero. Aside from maybe avoiding individual crises, but we're clearly beyond just an individual crisis at this point, right? So I don't know. Okay, we're gonna have the press conference here soon, so. So I will put it up here, I guess. Schumer talking about raising the FDIC limit. I don't know if that one's going to happen. I'm really concerned. They're going to try and do it. The Republicans are going to shoot it down, and then everybody's going to get mad at the Republicans for shooting it down. Because if the Federal Reserve, if Congress is unable to pass it, I think that alone could trigger a bank run, right? At that point, why would anybody keep their money in regional bank? What's your incentive to stay in the regional bank at that point? I don't see that there is one. Okay, so it looks like it's starting. I'm going to turn my news squawk off here so we can hear them. Yeah, we can do that. Should I keep the music? I've been wondering if I should keep the music on during these things or not. All right.
Before discussing today's meeting, let me briefly address recent developments.
Turn it down just a tad.
In the past 2 weeks, serious difficulties at a small number of banks have emerged. History
No, we'll just turn this part off.
isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong
Somebody
capital
just
and
ate up
liquidity.
2 ticks
We will
there.
continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
Oof.
Turning to the broader economy.
Oh, no, Phil, come on.
Inflation remains too high, and the labor market continues to be very tight.
Oh,
My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year.
And stuff. I mean, you can if you want, but that seemed like a distraction. Like you'd have to put a lot of effort into posting those.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants
all the way back there again?
Subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices.
Felt like that was a pretty decent decline that we had there, but I don't know if it was based on anything that he said.
At the end of this year, and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in
recovering
at 6%, and the change in the core CPI was 5.5%.
Oh, I see that. There's a big old monster there at 12 in the 5-year.
But the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
That would be lovely if that's the way that it actually went, but I don't think that it's going to play out that way, do you?
Expectations appear to remain well anchored, as reflected in
Sit up straight, Seth.
surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to.
It sounds shaky.
Of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
I mean, I got to say, man, everything that I hear is inflation is still a problem, and the situation has not changed at all.
And we are continuing the process of significantly reducing.
So why buy the treasuries?
Since our previous FOMC meeting, economic indicators have generally come in stronger than expected.
They're going to blow me. Look at that. Oh, yeah.
Inflation. We believe, however, that events in the banking system over the
this
past
out of
2
here.
weeks are likely to result in tighter credit conditions for households and businesses, which would
I see a
in turn
little
affect
bit of
economic
suspicious
outcomes.
spoofing and stuff up
It
here.
is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond.
Too
As a
soon,
result,
huh?
we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward.
Easy Money documentary on no, I was not aware of that.
The median participant projects that the appropriate level of the federal funds rate will be
Do you still get regular television?
4.3% at the end of 2024,
Is it on YouTube?
3.1%.
I watch it on YouTube. Does PBS have
These are little changed from our
PBS
December
does have YouTube
projections, reflecting
channels.
offsetting factors.
It's on YouTube. Okay.
These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals.
Okay, so in this situation,
To make our decisions meeting by meeting.
I think
based
that
on the totality of the
I've got the thing wrong,
and their implications.
but let's continue to try and play it.
Activity and inflation.
Okay.
We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to
There's
require
some
a
that
period of
bid, that
some
05 half, that
softening
kind
in
of
labor
keeps
market
following it up.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to
I bet you the press is going to give him a lot of shit. No, this is just a sim chain. So we're just practicing doing the market making bit here.
How confident is the committee?
So in this case, we got a loser. Let's see if we can market make it out and get our cost basis higher.
And that deposit flight among mid-sized lenders in particular has ceased.
Okay.
Thanks. So I guess our view is that the banking system is
A little
sound,
late.
it's resilient, it's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that depositor savings are safe, that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all
Oh,
of this
man.
and the uncertainty that you've also alluded
Oh,
to in the
man.
statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running
I
up.
did consider it.
And you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we're clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has
She's smiling because she knows that she got him to say something that he had prepared.
over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate.
Well,
Going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
I'm not quite sure I understand why that's dovish, but okay.
The difference between ongoing rate increases and firming. Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may, some, as opposed to ongoing.
Yeah, the rates are coming down
What we
pretty
were doing
good.
was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible.
This
that
most recent move, I see more steepening.
will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path
Sorry, what did I say?
might look different.
I don't see how anything that he just said is dovish.
Tightening will contribute
I don't see how anything that he just said means buy treasuries.
conditions over time, and in principle, if
There was a very clear, direct reaction to his comments. I think that I am missing something here. I'm misunderstanding something.
Today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic.
So he said that
on this potential
it was a unanimous
what can that
decision to raise rates,
tighter credit conditions,
and that they thought that
when we think about
what has happened will lead to tighter credit conditions, which is kind of like higher interest rates.
stability tools in particular are lending
The market read that as dovish.
the debt, the discount window, and also the new facility.
So I think I'm to my limit where I kind of have to puke it.
Nick Timmeros,
Right.
the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate was higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your
Strip is calling shenanigans. What do you mean by that,
I just come
Octavius?
from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their from.
If you think that what just happened
also just
tightens
this is 12 days ago.
tightens monetary conditions,
That's something that
and you still raised interest rates a quarter of a point, that means that you're really concerned about inflation.
so much
Well,
uncertainty.
how is that you buy treasuries off of
place
that?
to start,
Doesn't
and
make sense to me at all.
wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates. And then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether
In other words, he's saying that he would have done 50 basis points if the crazy bank stuff hadn't have happened.
that you believe will be necessary without
What he's saying,
doing
right?
significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
No, Andre, what you're saying doesn't make any
I wanted
sense.
to ask,
Dovish
you,
is
along
down,
with
which
the
would
FDIC
make
and the
market up.
Treasury, the Fed board decided to invoke the systemic risk exception.
Dovish is
to allow
buy
uninsured
treasuries.
depositors to be protected at these two banks. And I was just
Hawkish
wondering
is
if you
sell
could speak
treasuries.
to Why that decision
Generally
was made. Was it
speaking.
purely a confidence issue, or was there a concern,
Like all other things being equal,
economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is
So
of
let's
course,
flat
leading that
this
review.
now.
And he's responsible for it in his capacity
My sim
as Vice
trade.
Chair for supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so
If Powell says something that's dovish, then all other things being equal, the S&P 500 will tend to buy.
going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is
The only way that him saying something dovish would be bad for the S&P 500 would be if there was some sort of insinuation in the comments that the Federal Reserve is concerned about or knows about something that the rest of the market doesn't, and that would cause them to be more dovish, and that equity indexes should be concerned about, right?
February, and we still don't have now, is
This market does what the heck it wants. It could be. I mean,
services sector, and that is
when you come over here and you look at the 30-minute chart,
demand, and
that's a pretty big up move in the Treasury, right?
and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
But maybe YouTube doesn't like the name killer.
Hi, Chair Powell. Gina Smilek from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us,
He should have said faster than previously experienced in the historical record.
My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again. And then implement those policies. it would be inappropriate for me at this stage to offer my views on what the answers might be. You know, I simply can't do that. Vice Chair Barr.
Why 25?
And
Somebody would just went
next week. So, but that will be up to him. So that's really where it is. You know,
there's a big bid all the way down here at 25. That's so far away.
It's clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that you know, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, just and the final point, you know, can we feel confident that
The new NASDAQ
exist elsewhere given that they existed this bank?
Oh, you guys.
Weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of
I think he's gonna regret saying this.
Uninsured deposits and
I think he's gonna regret saying this.
Holdings of
To say that this is a problem that's only like it's really one bank and you know, nobody else is gonna have this problem or anything. I don't.
They were on this issue, but nonetheless, this still happened.
I don't agree.
So that's really the nature of the of the review, is to
I think that every regional bank is at risk of a similar bank run at this point.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply.
Okay, got something there.
With inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward...
so he's basically saying they disagree with the market.
Are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policy
smack that down
tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those.
Dude, if this touches 0.25, I'm gonna wig out.
You know, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
114.25. Oh no, out 25. 114.25.
Hi, Chair Powell. Rachel Siegel.
That's
from
so far
Washington
down
Post. Thank you
there.
for taking our questions. I know we've
Do you see the big order right there? 1579 at 1425.
But there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next.
If it got up there, that's so suspicious. Like, how did that guy know?
Is there a risk that could mimic the kind of what we saw with SVB?
That really threw cold water on things, though, didn't it? I was so right, though. I was like, I think the market is misunderstanding. Well, did I say I think the market is misunderstanding? No, I just said that doesn't. I don't see how that is dovish.
It is sound. It is resilient. It's well capitalized, and I really don't see that as at all analogous to this.
And one other question: would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that
you don't give advice to the fiscal authorities.
Comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
Next time somebody says Federal Reserve can't do X or Y because they can't afford the payments or some other kind of fiscal reason, just replay that back to them.
Look at,
this is never going to change. Their responsibility is price stability.
Tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal
Come on, baby.
Not what's driving inflation.
Let's go.
It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with
So where did I puke?
Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago.
9.5.
First, why is this new bank funding facility done under
A little bit better.
authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that guarantee?
Sure. So 13.3.
Like I said, the reporters are giving him a hard time today, don't you think? They're asking him tough questions.
We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to.
So that entire run higher
lending to
that we started since he started speaking reversed hardcore.
It's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
There's still about 20K, 10 to 20K more down to go to get to cumulative delta levels that are below what they were before the statement, though.
Change in the language in the statement.
And which probably plenty more turns in this story to go.
Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed? Or
there's some big bids there. There's a couple of 3 or 4 1,000s down here between 02 and 115 even.
If we need to raise
What's this?
Raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all,
I don't know if this is too good of a trade in ZN and stuff, because I had a loss and I puked it and only got a little bit higher. I puked it at 09.5, so I picked up 3 ticks on there, but I wrote it all the way back down.
Thoughts are on the
availability
of reserves, but the distribution.
If I get 25, then we can say that's an amazing trade, right?
You might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
U.S. Treasury Secretary Yellen, smaller community bank failure could trigger bank runs as a much larger bank.
The minutes of the January, February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent,
Well, the 10-year is right at 3.5. What do you think?
Of that. It's
higher or lower?
Interesting 7 weeks. But I will tell you, though, that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory
Put up a poll here. See if you guys think by the end of the week we'll be above or below 3.5%.
Repeatedly and was escalating, but nonetheless, what happened. And so that's really the purpose of one way to think about the review.
Spies down, but spews up.
Bar is conducting is.
Oh man, SPY is getting hammered here, isn't it?
Understand how we can do better and what policies we need to change. I mean, one thing is the speed of the. I'll come back to that. The speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
It's very rare for him to just be like, I don't know.
Chair Powell, you stated twice today that all depositors' savings in the banking system.
He would look like a deer in the headlights on that one. He was like,
deposit insurance.
I don't think I should answer this. Come on, go.
And just by way of example, if a bank with less than $1 billion,
this could be so good, guys.
Are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Let's go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Aren't you? A sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
That's an estimate.
You would ask that, CNN.
What will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate, and I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to
there we're going.
stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see
Did you just say there would be a recession?
You see low unemployment. You see the benefits of wages going to people at the lower end of the wage spectrum.
So she asked, how are you sure that it's not gonna like spiral out of control, sort of a thing? And the answer that I heard was, it's pretty likely that it will spiral out of control at some point. That's what I heard.
Of a soft landing for the U.S. economy.
I'm not saying that's the way it is, but that's what I heard.
It's too early to say, really, whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period.
That last decline was
sustained,
painful.
Then the greater will
for the longs. Because these guys are all long from like 28, around 28. So if they start getting to 28, then they're really sweating, right?
Credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious. Those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question, and is right in the heart of what the review will be doing under Vice Chair Barr's leadership.
Hey, that was a good bounce so far.
I think that's
back into this area where we've had a lot more volume in the 03.
Again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them, because I really, this review's going on. And I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank. And under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Last question already? Wait.
Jennifer Schonberger with Yahoo Finance.
So you see what just happened there, right? He stumbled around a little bit, and they said, okay, he seems to be getting tired or off his game, so we're going to end it early. This would be ending it early.
Situation would warrant a rate cut.
Right? This would be a FOMC that only went 45 minutes instead of an hour.
The balance sheet runoff. Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
KRE is getting hammered.
Curious how you view financial conditions now, and if
Yeah,
credit
okay.
were to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities.
Oh, you're right, they are.
Lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show
Since the S&P 500 peaked off here.
that be, and how, what will be
So when the rates started going higher, that's when the KRE started getting hammered again.
Once you know that, there's a fair amount of research about how
Man, they're still right at 3.5, aren't they?
how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have
Those bids aren't very firm.
macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say.
Rate cuts are not in our base case.
Thank you very much.
Bye-bye. Guys, I don't think that was good. Like, I could just be reading into like a whole lot of nothing, but I think that they cut the press conference short there. I think he was stumbling a little bit at the end. And yeah, it totally reversed the movement from earlier. Oh gosh, what just happened there to Spotify? It like died. It was a big yikes, yeah. And they ended the press conference early. They ended it early. But yes, if I come over here and I look at the KRE is down. And I come over here and I look at the treasuries, and yes, it was right there at about 1250. That was like the Biden shuffle. I think it was. Like the lady that's asking, that's calling on people, is like the handler basically said one more question after he started stumbling there. Not like it was a big deal, a question or anything, but like, good grief. The press conference almost always goes an hour. Am I wrong? Am I crazy? Sometimes I remember things and it's like, oh, I don't know if that's something that I would actually like actively remember, but it seems to me like the press conference is usually an hour. And it going 45 minutes is weird. Cutting it short at 45 minutes is weird. And he was stumbling. It seems to me, so the thing that they were kind of talking about there where he started stumbling was about investigating what was going on with the banks and everything. The people on the left have been insinuating that Powell, or Elizabeth Warren in particular, has been saying that Powell should not be involved in any kind of investigation. And he was saying, that there's all sorts of people here that are going to be investigating that have no connection to the bank whatsoever. But he stumbled over his words. It was making him uncomfortable. That's what I noticed. Not that I'm like an expert in body language and people and all that sort of thing, but that was weird, man. And I have to add, going to the stuff we were talking about earlier, the whole like markets buying up the treasuries on this made zero sense to me whatsoever. We're in for it? What do you mean by that? I would love to. I shouldn't say I would love, but if the treasuries were to move lower here, that would be cool. Can I say that? That sounds like fun. Let's sell the treasuries all the way back down. Retrade all the way back to 114.16, which is where we started. That would just be like, ooh, that would just make my day. I don't know if this is going to happen. So let's see. Nick Timrose. Powell is dismissive of the financial conditions indexes, which don't necessarily capture lending conditions and are overweight equities and rates. He indicates that the credit contraction from regional and small bank stress could easily have a significant macroeconomic effect. Back up to 06, huh? Well, what we do from here, I have to say, I've never been very good at sorting out what the markets will do after the press conference. I often feel like that what it does is just random, but so far I've seen like, oh, you know what? The other thing was that decline was going into the options pit close. And then since then, it's just kind of been like, it just kind of like bounced, floating away, like the trade is over. Well, it could be an interesting next 40 minutes, but let's see. So far, the treasuries appear to have formulated a little bit of a range here, with the top side being 06.5 and the bottom side being 01.5. And you're creating a pretty good distribution there already. There was quite a bit of distribution in that area. So, be interested if there was a breach, but I'm kind of starting to get flashbacks of like, you want something to happen and then it never actually goes, you know? I'm getting those flashbacks right now. It's like you think you really got a good trade and you're just hanging on and it never happens. Joe Weisenthal tweets, they need to get a handle on this uninsured depositor question, come up with some line, or change the law. I agree. What I'm hearing from both the regulator and the congressional side here has me concerned about the future of small regional banks. Whoa, Spoo's rallying hard here now since they ended. Yeah, I was right about when they said that was like it. The Spoos started rallying. The people buying the 0 day to expiration options for that one. I shaved like 2 days ago, kind of cleaned the beard up. And there's like this one hair here that got missed and is longer than the other ones. And it just keeps going through my head. And I want to feel it and I can't forget about it. It's just like, it's driving me crazy. So, what do you guys think about the press conference? Because coming in, there was a lot of hype about it, and that this could be a historic press conference and everything. I kind of felt like it ended up being a nothing burger. Can't relate. Do you have like a long beard? You know, the other day, I was looking at it, and it was just the right length that you could see the gray coming in a little bit. And I was like, I was liking it. I was like, I look very distinguished and experienced this way. I think I like it. I think I would like this. But the issue that I keep having is that like once it gets about yay long, it looks too scraggly to me. I just can't do it. I don't have a neck because of this beautiful mane. I saw this study on Reddit the other day that showed that the beard actually does like protect you in a fist fight and stuff. I was like, oh, okay. So it is there to, for fighting. You got to get that blow dryer and straighten it out. Is that what it is? I was like looking for combs and stuff, but yeah, it seems like that there's like work that to get it. And the other thing is that like it curls. So you kind of get this thing where there's a period at least where like the hairs will turn around and poke you in the face. You know what I mean? I really hate that too. Blow dryer and a comb. I don't know, because they're not like super curly. They're just curly enough to make it look unkempt. Probably would just need to be a lot longer in order to really. Brush daily or often to train the follicles to grow down. Luke, are you on board with 25? I don't know if you're listening to the stream or not because you're posting this in Discord, Luke, but I would have done 25 basis points. I think that the last thing you want to do is let the market think that you're going to let inflation get out of control because of some minor inconveniences in the banking system. Like, they're really going to have something that, like, absolutely destroys the economy in order for that to... Oh, man, that was a strong buy that just came through there. I did have at points, like, got back to break even, but couldn't get it to break lower. That didn't look good. What's causing that? Is it the dollar? Yeah, the dollar did kind of start moving lower there. Could be the dollar. Well, I wouldn't expect me to be super good at an exit in this situation. I'm gonna try and hold it to the close. But I do think that the re-entry on this trade was really good. Like, I identified that he was saying something, I could see the fight in the market and took it, and it really played out for me. So I'm proud of that one. Is Janet Yellen speaking right now? Situations like the run on SVB may more readily happen in the future. Regulations may need rethinking. Nick Timrose pointing out equities appear to react to this comment from Janet Yellen during Powell's press conference. Yellen says Treasury is not considering or working on unilateral expansion of deposit insurance. That could be. That leads to something kind of paradoxical here, which is that if it's Yellen, it's saying that is like increases risk aversion in the market and causes the treasuries to bid, right? So when did she say that? It was right about 1 o'clock. So it was around the time that we started moving down, but that was also when it started to shift back up. So, well, dang, guys, I think that I have to take it off. I could leave one on. And now seeing all that blue makes me feel a little bit better. But I think that this trade was a dud. I'm kind of thinking back on it now because there was a point at which I was like, maybe I should brush off my retail account and just. I think it was when I was short and it was going up, and I was like, maybe I should dust off the retail account. It's not dust off. I mean, I used it yesterday, but I was like, maybe I should go for it here on this one. And then I was like, no. Like, you have no clue what's going to go on here, and trading the press conference is always a shit show, right? Well, there you go. It was a shit show. So let's come back to Zero Hedge and see if they've updated their stories. Wall Street reacts. Jan Hazius. The FOMC raised the target range for the federal funds rate by 25 points to 7.75% to 5%. The post-meeting statement noted that while the banking system is sound and resilient, the recent banking stress is likely to weigh on economic activity, hiring, and inflation. The FOMC removed the reference to ongoing hikes in the post-meeting statement and noted instead that additional policy firming may be appropriate. The committee reiterated that it remains highly attentive to inflation risks. The median dot in the summary of economic projections shows a funds rate of 5.125 at the end of 2023, unchanged from the December projections. The median projection in the S&P showed lower GDP growth and somewhat higher core inflation. Eric Winograd, senior economist at Alliance Bernstein. So far, my takeaway is that the committee has left all the hard work for Chair Powell in his press conference. If you just look at the statement and the materials, there isn't a change to their outlook for a few months. From a few months ago, so he will have to describe how they are thinking about the banking issues as they relate to the economy. Oh man, I shouldn't have dumped that. More, maybe I could dump it here. Yeah, well. Yeah, well. It was a fun stream. Oh, I'm glad. I wish that my my luck was better today. Because I really think that's what I'm doing here. I find it really frustrating when I feel like I'm not in sync with the market, when I feel like I'm not the informed one, right? That's what it's kind of suggesting to me, is that you're not informed. But there's maybe, I don't know. I really shouldn't get on myself, because it's really a lot to expect to be the informed one in this situation, because there's just so much flow going around at this moment that you really can't make those kinds of calls. You really can't. You know, I think that to take a trade right now I would have to be taking a trade that is like, I'm going long interest rates, and I'm planning on holding it for like the next week or the next month. I think that's the kind of call you'd have to be making, to really be trying to make an informed trade in this kind of situation. There are some situations where you really can catch a flow and write it, but I think that we had some difficulty doing that today. You're the lucky one. No large institutional. In this kind of a situation, it's like it's a lot of speculation, right? I mean, I think that there's all sorts of flows going through. What they actually are, I would love to see a breakdown of like, okay, on FOMC day today, how much of the volume was from this institution and how much of the volume was from this and that, like categorize it. But all we know is that during these events, you just get a lot of volume. Oh man, if they reach 115 even, I'm going to be so bitterly disappointed because I had such a good trade. It came all the way, did it come all the way back? It came almost all the way back. Actually, you know what they did was they went and they blew the stops of the market maker and then came back. I'm telling you, man, these lines, you see it right here? The number of times that they will come and bounce off of one of those lines is just unreal sometimes. I wish I could sort that out into a strategy that I could like show you and prove to you that has some efficacy, sort of a thing. Because there's definitely something to it. But I think that in order for me to show the statistical kind of aberration there with it, I would have to be able to identify the situations where there's a flow that's going to come and go and hit it. And that sort of thing. No, we can make these movies because of all the massive inflows of volume. I mean, I think that if you have a lot of money to be able to play with, you could. I'm really surprised you haven't coded one of your favorite projects into a strategy. Well, so I've coded like almost everything into a strategy of some sort, dude. But like what it always comes back to is that there's not enough edge in that particular thing for me to want to try and just run the robot. It always comes back to I probably do better trading myself, doing it myself. And the ones that where like I probably like having the robot would be like a real advantage. I don't trust the data, and it's like I go in and I start forward testing it and just doesn't appear as effective as I think it should, so I kind of give up on it. But for instance, I have one that looks for autocorrelated volume, and I mean, look, I mean, I've shown you guys this before, right? How many different, I'm gotten to the point where I have so many strategies that I just can't even like keep track of it all. I have some work to do. I don't, what do we got tomorrow? Okay, so like when you come in here to strategies, like look at how many strategies I have. Like every one of those ones that has a little paper next to it The ones with the clear paper and the lock, those ones, but all the ones that have papers with lines, those are strategies that I've made. And that's just, and look at how many folders there are. In each one of these folders, is like, you know, 5. I mean, like, look at that. Like, each one of these folders is a ton of strategies. I mean, I do, but I don't. Okay, so if you have a chart and it looks like this, okay, then R squared will be like this. It'll be 0. It'll be 0 because there's no autocorrelation. It's just going sideways. There's no, it's not like, you know, when autocorrelated would mean that this price data series is predictive of the next one, at least during that period, right? So if I have a chart that goes like this and it's perfectly straight, like perfectly straight going up, right? Then the autocorrelation, so if it's going from here, it would start at 0 and it would move up to 100 and then stay there like that, as long as it keeps moving up. And then when it starts coming back down, then you'll see the autocorrelation start to come down. Okay. So that's what autocorrelated means. It means that it's in line with itself. A bar up predicts that the next bar will be up. Okay. So then what you do is, instead of running that indicator on price, you run that indicator on cumulative delta, right? That's all it means. So like, if for instance we came in, added another chart here and did ZN 1 minute only today, tick replay. My nose really itches. Okay. And we'll kind of make it wide so that we can see this stuff from earlier in the day. Okay. So you notice here, price is fairly autocorrelated. So let's come in here and add R squared. And let's add delta V4. Okay. And I think, oh, I want to do it over a much wider period. I want to do it over like 60 minutes. Okay, there you go. So for instance, right here, we got a strong trend. It's like it's trending up. And so what do you see? Autocorrelation goes up to 1. Right? So now let's add that to the cumulative delta. So I have over in here, I can add R squared again. R squared. But then in here, in the input series, I can say use an indicator. And use my cumulative delta 2. Reset delta, never. Okay. Okay. Oops. I didn't set the time period on it correctly. It needs to be an hour, right? Otherwise it's a little too tight. Too noisy. Okay. So now you get to see that, okay, when we started this morning, it was kind of like all over the place. And so the cumulative delta R2 was kind of low, right? But then as we started to catch this long trend, cumulative delta. Let's make this a little bit bigger so that you can see the cumulative delta. Okay. Cumulative delta is going up, and so what do you get? R squared goes above 0.75, goes up to 1. It means it's highly autocorrelated, right? So when you start to see that autocorrelation start to tick up, the tendency is going to be that it's going to be autocorrelated for at least an hour because there's a likelihood of a large meta order going off. Yep. Okay, so then what was the exact strategy? Did I close? I did. I'm gonna close that chart and open up the editor. Oh, not indicators, strategies. I think it was order flow, wasn't it? Auto-correlated flow. Yep. So then I say I have a correlation threshold. I have this sign here just so that I could like sort out the back testing, and I could use machine learning for the back testing. But basically, when the correlation threshold has been passed and there's been a certain amount of an imbalance. So I keep track of like what the low imbalance was during the period. Where does that get set actually? I don't know where that gets set. How do I come up with that? Double imbalance low, imbalance high. Oh, okay, yeah. The amount of imbalance on an individual bar has to be above a certain amount. So I can come in and say, okay, if there's autocorrelation and there was an imbalance of 1,000 lots, then I buy. And that's it. That's the strategy. And if I come back and I look at the backtest of it, so the strategy analyzer here has this nifty feature down at the bottom that a lot of people don't know about called the log. So you can right click properties and make sure that show log is checked. I think it's down towards the bottom here. Yep, show log, right? So now these are all of the back tests that I've ever done, and you can come in here and say, this one doesn't count, so just don't check it, and then you can erase the ones that you don't have checked. Okay. So, for instance, this was the price action strategy that we did. It gets a sharp review of 0.08, which is absolutely dismal. Profit factor of 1.13, I guess isn't terrible. So now I can sort all of my strategy by these things, right? What has the best profit factor? That would be, what you would be getting the most for your money from. Well, I have a couple that are like really big, but the number of trades. Okay, so I did one with auto-correlated flow where it didn't take very many trades. And look at the profit factor on that. And look at the percent profitable. 62.71. This one right here. So then I can click on it. I don't know if I have to double click on it or whatever. Okay, there you got on it. Okay, so it took mostly short trades. Average winning trade, far, far more than your average losing trade as well. So look at that. If I had 10,000 trades, or let's even say if I had 1,000, 2,000 trades, and those stats held up, that would be like the golden algo. Look at that. You're making almost 3-to-1 reward and you're hitting 63%? What? What? 3-to-1 risk reward and 61%? Wow. It's not enough. It's not enough samples. From 2017 to 2022, it only took 59 trades. So that could be deceptive. Okay. So then, but another one that I've got is, oh, actually, what is the most percent profitable? I think I have one that's even a little bit higher than that. Oh yeah, it was the range deviation one. This one isn't terrible. This one isn't terrible. This one you're getting. Oh, okay. This one takes lots of risk on it. So this one is taking. It has a stop twice as much as its target. But it does it within a range and it does work. Yeah. Running XYZ strategy day trade. Yeah. Well, you know what? So tomorrow, Uzi, when I start the stream, remind me and I will add it, because I had a chart to run the strategy on, and I kind of had it in the background because I didn't want to look at it, and I just forget to start the strategy because I was like, oh, I should forward test this one, and I forgot to turn it on. Right. This range dev one is interesting. That one. So the problem with this one is that because of the skewed risk reward that it has, I would probably need 10 times as many trades to feel comfortable with that one. But the Sharpe ratio isn't terrible. If I click on this, does it take a long time for it to do the analysis on it? Yeah, you're right. It is good content. I don't. See, here's my ultimate problem, really. So it comes to. So I think you said this thing the other day that I was kind of like, well, no, I don't think that's it, because you were saying, well, I think that this mostly comes down to like other people are more popular than you. You don't like it. Well, I mean, I guess it does kind of bother me, but like, I care more about like my own trading than I do about the stream. I guess in the end. I care more about my own trading, and I care more about that my audience is getting better than I do about how well the stream does or how much money I'm making from it, right? Yeah, I'm trying to help no matter how. You know what, Uzi? That's why you are. I mean, I want to call you like a best friend, because I've never met you before, but you're one of my best friends. You really are, and that's what makes you so perfect, and it's the kind of person that I want to be too. Is obviously you don't get into relationships with people that are like abusive and that sort of a thing. Okay, that can end bad, but I want to be the person that is going to be there for you even when you're not on and you're saying and you're being dumb, or you're doing something that they don't like, whatever the deal is, right? Oh, are we moving higher there in the treasuries now, huh? I think that it would take too long for me to be able to see the chart here, so I'm just gonna move on. Your audience wants to see you get better, though. Yeah. Anyways, the thing is, the problem that I think I run into a lot is that, like, in some ways I'm kind of making content for myself. Which is to say, like, this is the content that I wish I had when I started, right? But it doesn't necessarily match the audience. And far too often when the stuff that would match the audience is stuff that I'm not interested in. So, like, to me, pulling up a strategy that, like, we've back tested and running it live isn't very interesting to me, because I know that it usually doesn't factor out that well. But we should run that one. The auto-correlated order flow is the best one. So I just want to show you from a couple of other perspectives. Another one is like total net profit. So this is where it gets kind of crazy. Okay. So this one right here, this total net profit one. Oh, there's only 86 trades on that one. I don't think we should trust that one. Let's not do that one. Oh, that's right. The linear deviation one. That one's terrible. So some of these strategies, they come out and they actually look really profitable. And the whole thing is that like they're actually quite terrible. They're actually like the Sharpe ratio is quite awful, but because they've taken so many trades and whatnot, like it works out in its favor and it's okay. So like this one linear deviation, I think the whole concept behind that is suspect, right? But it's one of the most profitable ones. But you know what else is a really profitable one? And this is one that you could do. The Sharpe ratio is not super great on this one either, but this Fourier strat, I did a walk forward on it. This one is likely to translate to live. That one's likely to translate to live. Actually, I think we did try testing that one. And I think that it turned out that like the time period that we did it was just weird shit was going on. Okay, but then getting to where we were actually getting to, or you know where this is building up to, is what has the best Sharpe ratio? Yeah, ZN is running away. I can see it here on this chart, man. It's like oh, you know what? I didn't. Okay. So I can scratch it now. I thought I got out of that trade. Oh my gosh, guys, I'm so dumb. I don't see the buy on it, but it's running for sure. Okay, so look at this one. You know what? This is funny. Is was it Live Action that gave me this one? I don't remember who it was, but somebody very, very early on in the stream said that they had back tested this, and so I tried it, and they were right. All this is doing is using a volume weighted moving average with a really long period, an SMA period and a W volume weighted moving average period, like very high ones, and you only go long on the S&P 500. That's pretty good. And the Sharpe ratio is over 1, and we have 2,000 trades. Those are stats that we could work with. I think this one, let's see here. Oh, that was only on just 2020? What if we, yeah, you want to come back and try it on going till today? Oh, you know what? This one requires tick replay. Never mind. A delta inverse, that's not one very many. Here's J. J was the one that was it was performing really, really good. But when we started testing that one live, it didn't translate, and it's not quite enough trades. Right? But then you get to the autocorrelated flow. Look at how much autocorrelated flow stands out, right? Very, very high win rate. Very, very high profit factor. Sharpe ratio above, it's 0.78. Right? Is that one luck? It could be. To be honest with you. Because the issue with this one is that it's only 2 years of data, basically. Right? It's from 2021 all the way through to October of 2022. So I can only do it 2 years. Oh, being able to scratch that trade luck, yeah. Totally. The S&P 500 is bad. I think that there's something else is going on here. I think that, well, it's okay. It's okay with me being distracted. I don't think that I would have flipped around and gone long. Anyway, so there is something about very promising about the auto-correlated flow, but we would need more data, right? If I could backtest that over 5 years and it came out like that, that could be a potential fund, like could turn that into a fund sort of a thing. And I don't run it because I keep forgetting, because I always forget. So that's why I talk about the autocorrelated flow thing. The other thing is like, look, it works long and short. The other thing is the probability being 0.67. That's not very good. My portfolio day just cratered. Yeah, I think that what happened was Janet Yellen made her comments and the market was reacting to that. And it was not actually reacting to what Chairman Powell was saying at the moment, even though he was saying something relevant. Isn't that interesting? And so the treasuries are buying because it's risk off again. That's what this is. This is, oh yeah, now we're going to start a bank run on all of the regional banks. That's what this is. A significant minority of FOMC officials, 7 of the 18, now see inflation risks balanced. This is a really massive order there at 115.16. I guess it's at 16 that could be part of it. Can you believe, like, that's a handle from where this started? That sucks that we didn't get 25, man. You know what happened though was, like, once I realized that it was like, oh, maybe it is because of what Janet Yellen is saying, I said, well, we're lucky that we've gotten as much as we had. Let's just take it off and let the one contract run. I probably should have just taken it all off if I was planning on checking out like I have. But... oh, dude, what the fuck? Oh, man, look at this one. Look at Bitcoin, man. Whoa. Bitcoin is cratering. Oh my gosh, it's cratering so hard. That is a pretty hard sell, man. Someone there got uncomfortable? I don't know, but now the S&P is, well, we're going into the close. That's what that is. Oh, look at how much absorption at the lows. Wow. Closed at the low of the day. Interesting. I mean, anything that I would have done over here on Sim or whatever, it would have just been Sim and it would have just been me screwing around. But I think this suggests that we could have a day tomorrow. Like, we might have another zany day tomorrow and Friday. Because the market's saying it's not over. The market's saying... oh, man. The market's saying that you have to backstop all deposits or we're going to mutiny. That's what the market's saying, I think. And the problem is they can't backstop all of them. The FDIC only has so much money. And they have to do it with an act of Congress, and Congress isn't going to do it. So we have to hope that the market throws an absolute fit and that everything ends up being okay. Because that's it, man. Oh, man. Well, that was the close. Yeah, you remind me tomorrow when we start the stream, we'll start that algorithm. I could even put it up over here. Like, I could put the tabs on and, you know, do it that way. Thanks for streaming. We had fun today. Today was a lot better than the last days when I was arguing with you guys. I think we sorted it out. I don't know. Going, you know, like one more thought and then we'll go, because you're talking about like what sort of things make the stream. Well, yeah, okay, so like making this a journey that's like, you know, we're running this algorithm and seeing how it does and all this sort of stuff. That does work for streams when you have like the journey. I kind of feel like that most viewers should see themselves as the hero and not me as the hero, but I guess in some respects I am the hero sometimes too. But I've always found that on the YouTube channel, the videos that did the best are the ones that are like about the platform or about hardware or that sort of a thing, you know? And that I should make more videos like that. I may make a video about the desk. That might be... We'll see what we do. It'll be interesting though. All right, well, I do have some work to do today. So, I will see you tomorrow. In the meantime, stay